Investing in the stock market gives you, me, and regular people the opportunity to invest in and own a piece of some of the biggest companies in the world. But you want to make sure that you're doing it the right way, and by the end of this video, you'll know exactly how to do that. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com and welcome to The Minority Mindset. Can you imagine how much money McDonald's makes? I mean, they have restaurants on almost every major intersection in America. Man, if only there was a way to own a big company like McDonald's without having to flip burgers. Well, you can. If you take $100 and now instead of going and buying a bunch of Big Macs, you go and buy some McDonald's stock, now you would be one of the owners of McDonald's. And if a lot of people go out and they buy a bunch of burgers and fries at McDonald's and McDonald's makes a lot of money, you make some money too. But there's more to investing in stocks than just closing your eyes, picking a random stock, and then throwing your money in it. I pick JCPenney. Oh no. The majority of people think that investing in stocks means picking a hot stock and then gambling your money in it and then hoping for the best. And that's why the vast majority of people lose money in the stock market. But that's also why we're the Minority Mindset, because we're not gonna think like that. The stock market is just a rigged casino. Actually, the stock market is a wealth building tool that wealthy people understand how to use successfully. And if you want to use the stock market successfully, you should learn from what wealthy people do. That way you can copy their systems and use what they're doing to get similar returns. That's why in this video, we're gonna be talking about what you need to know to be a successful stock market investor. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too, because if you don't, then YouTube doesn't let you know when our new videos are released. Unlike what a lot of people say on the internet, investing is not a way for you to get rich quick. Investing is a way for you to build wealth slowly. If you are not interested in the long-term game and you are solely focused on getting rich tomorrow, then it's going to be very easy to suck you into those get-rich-quick systems where people are selling you lists of the hottest penny stocks that you have to buy today. There's a reason why the most successful investors in the world are long-term investors, not penny stock traders. Investing is also not a guaranteed way to make money. You can lose money when you invest, which is why investing has risks. So you want to make sure you always do your own research before you invest your money, and you want to never blindly just listen to a random guy on YouTube. Who you calling random, Jaspreet? The three things that I want you to pay attention to that we're going to be talking about today are how to find a good investment, how to buy a good investment, and knowing and understanding the numbers. Let's start by talking about how to find a good investment. The stock market is made up of different companies called stocks. And now when you invest in a stock, you get shares or ownership in that company. So if you buy one share of McDonald's, you now become one of the owners of McDonald's. There are a lot of different companies and industries in the world. Like you have tech companies like Amazon, you have retail companies like Lululemon, you have startup companies like Beyond Meat, you have oil companies like ExxonMobil, and you have financial companies like JP Morgan Chase Bank. In the stock market, these different industries are called sectors. And you've probably heard people say that you need to diversify your money in the stock market. Well, when they say that, that doesn't just mean you should invest in Apple and Amazon and different tech companies, because that's all within one sector. Diversification really means investing across different sectors, because if you put all your money in just the tech sector and the internet goes out, now the tech sector is going to be disproportionately affected compared to the oil sector. So you want to start by finding some sectors that you want to invest in. So let's say for the sake of this example that you want to invest in tech, financial, and retail. Once you know that, now you have to find potential companies to invest in within these sectors. There's a lot of ways to do that. You can buy subscriptions to financial newsletters, buy subscriptions to stock alerts, read forums, read the financial news. But for the sake of this video, we're going to do something much simpler. All I want you to do is take out your credit card statement and look at where your money is going. Chipotle, why is your guac so extra? If you look at your Visa statement and it says you're spending a lot of money on Amazon, Netflix, Lululemon, and Walmart, and your Visa credit card is connected to your Chase bank account, now you got a few potential investment options. In tech, you're spending your money on Netflix and Amazon. In retail, you're spending your money at Lululemon and Walmart, which is a strange combination. And financially, you are spending money with Visa and banking with Chase. Now you have some potential tech, retail, and financial investment options. But before you just jump in and buy, you want to know the different ways that you can buy and invest in these sectors. One thing that you can do is you can invest directly into these companies. So you can buy shares of Amazon or Lululemon or Walmart or Netflix, or you can invest in funds called ETFs, which give you exposure to a bunch of different companies. So if you want to invest in tech, one thing that you can do is invest in Amazon or Netflix and hope that these companies are going to give you the best returns out of the whole tech sector. Or you can invest in a tech ETF like VGT, not telling you what to buy, just an example, but you can invest in VGT, which would give you exposure to over 300 different tech companies. When you invest in a tech ETF like VGT, now you are essentially investing in over 300 different tech companies without having to buy each individual company, because you're buying one fund that invests in these 300 some companies. So now you have exposure to the whole tech industry as a whole instead of just investing in one company like Amazon. The good news is your risk is lower, because if you invest all of your money into the Amazon stock and Amazon goes bankrupt, so does your investment. But if you invest into a tech ETF and Amazon went bankrupt, then yeah, the ETF would be hurt a little bit, but there are hundreds of other companies to balance out one bankrupt company. The downfall is your return is also averaged, because if one company shoots up, it's also going to be balanced out by some of the losers, so you're going to get more kind of like a generalized sector return. You can invest in sector-specific ETFs like the tech ETF I just talked about, or you can invest in ETFs that give you general exposure to the stock market as a whole. VOO and SPY don't give you exposure to just one sector. They both give you exposure to the top 500 companies in the stock market. So when you invest in these ETFs, you are essentially getting exposure to the general stock market. So if you were worried about trying to pick the perfect stock, using an ETF is a good way to go. The way you can invest in and buy stocks and ETFs is by using a stock brokerage like our sponsor Webull. All you have to do is open up a free account, and then you can buy and sell stocks or ETFs on their mobile app or on their computer, and you don't have to pay a penny to make a trade, because they are a commission-free brokerage. So you can use your money to invest instead of just using your money to make your broker richer. I'll show you how it works. So if you open up a free account, you can go to the app, and I'm going to search VOO, this ETF. And if I scroll down, so you can see the price it's trading for. If I scroll down and I click asset allocation right there, this will show me the different things that this fund invests in. So you can see that VOO invests heavily in stocks. And then if I scroll down a little bit more, it'll show you the different sectors that VOO invests in. So you can see how much it's investing in tech stocks, healthcare stocks, financial stocks, and on and on. And then if I scroll down just a little bit more, it'll show you the top 10 companies that this fund is investing in. So you can see Microsoft, Apple, Amazon. Now I'm going to compare this to a sector-specific ETF. So I'm going to go back, like VGT. Now, if I go to the same place, I'm going to go to asset allocation, scroll down, and you can see, okay, this invests in stocks again. And now here in the sector weighing section, you can see that it is very heavily investing into tech companies. And if I scroll down, you can see which are the top 10 holdings of this ETF. The cool thing about Webull is their social aspect, because you can chat with other investors regarding a stock or an ETF right off of their app, and you can keep up with the stock's news right on the app too. And the best part of all is that at the time of me recording this video, Webull is giving Minority Mindset fans 2 free stocks just for investing with them when you use our link in the description below. You get your first free stock just for opening up a free account, and you get your second free stock valued at up to $1,400 when you deposit $100 in your account. So if you want to learn more and get your free stocks, I got the link to where you can do that in the description below. Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. I mean, it's free to open an account, and they don't charge you a penny to make a trade. So if you want to learn more and get your free stocks, I got the link to where you can do that in the description below. Now that you know how to find a potential investment and how to buy stocks, it's time for you to understand the numbers. On the highest level, you have a company's market cap. You can think of a company's market cap almost like their net worth. It is the valuation of a company. Like at the time of me recording this video, Amazon has a market cap of right around $1.5 trillion. By the way, if you just click on that stock price for Amazon on Webull, that will open up all this other information that you see. To determine if a company is expensive or cheap, you want to look at its valuation relative to how much money this company is making. Like, let's say you and I both have a, flower business, and both of our companies make $100,000 a year after expenses, and we're selling the same thing, we're making the same amount of money, so you'd think that we'd both be valued at the same amount, right? Well, for the sake of this video, let's say that I'm willing to sell 10% of my business for $100,000, but you're willing to sell 10% of your business for $10,000. If somebody buys 10% of your business for $10,000, then your business would be valued at $100,000. And if somebody buys 10% of my business for $100,000, then my business would be valued at $1 million. But since we both made $100,000 worth of profit, I am selling shares in my business for 10 times earnings because my business is being valued at $1 million, but I made $100,000 worth of profit. So $100,000 worth of profit times 10 is that $1 million valuation. So I am selling my business for 10 times earnings. You are selling your business at a $100,000 valuation and you're making $100,000 a year. So you are selling shares in your business for 1 times earnings. Based off of these numbers alone, your business is cheaper than mine. You can do a similar analysis like this in the stock market by looking at a company's PE ratio or price to earnings ratio, because this is going to tell you how many times earnings a company is selling for. So going back to Amazon, so if I click this button, I can see that Amazon is selling for 148 times earnings. Now, if I want to compare that to Netflix, I can come over here and see that Netflix is selling for 87 times earnings. Based on these numbers alone, I can see that Netflix is cheaper than the Amazon stock, but you don't want to make an investment decision based solely on the PE ratio. You want to make sure that you're not comparing apples to oranges, because different sectors and different types of companies are going to have completely different normals for valuation levels. So a financial company and a tech company are going to have two completely different types of valuation that are going to be normal in the sector. The PE ratio is just something you should look at to determine how cheap or expensive a company is. What's even more important is that every 3 months or every quarter, a company is going to release what's called an earnings statement, where this company will come out and they're going to talk about how much money they made, what plans they have, and how much money they expect to make. You need to be paying attention to these earnings statements, because these earnings statements are going to give you an inside look as to what's going on in the company. I know it's a little bit tedious, but this is something you need to be doing because you want to make sure that your company is innovating and they plan to make more money next year than they do this year. Once you put these 3 things together, understanding how to find a good company, understanding how to invest in stocks, and understanding the numbers, you will have the tools you need to invest successfully, as long as now you add in that long-term mindset. Now what you want to do is you want to make sure you're managing your money the right way. That way you can keep adding more money to your investment portfolio each and every month or each and every week. This is where financial education comes in handy, because it's going to teach you, 1, how to invest your money, and it's going to teach you how to use your money the right way. And if you're looking for an easy way to up your financial education, well, that's why we wrote a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get our free ebook and start reading our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about how you can grow a small stock market portfolio into something much bigger, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.